This segment sponsored by Foster Financial. Welcome back to Wealth Wednesday with Foster Financial. I will be speaking with Caleb Doan, their Vice President, about what's going on in the financial world and things that you need to know to plan out in advance. Hey there, Caleb.
Hey.
Welcome back.
Thanks very much.
Okay, so last Monday we had talked about end of year planning and what that looked like when you're trying to get your Roth conversions and all that stuff handled. And you mentioned a little bit about RMDs, which are required minimum distributions.
Yeah, that's exactly right.
I'm learning these acronyms.
You're nailing it, yep.
But so we're going to dive deeper into that. So start off, like, what is a required minimum distribution?
Yeah, so this is the minimum amount that you are required to take out of a pre-tax retirement account by the end of the year.
Every year?
Yeah, every year. And so this starts when somebody is 73 years old. Under current legislation, it's at 73 years old. There's now a minimum amount that you have to take out, and the key part is, and pay taxes on, of course, by the end of the year. The first year that it starts, if you're 73 and it's your first year, they give you a little bit of a break. They say, hey, you can take it out before you file taxes the next year. But typically we like to have it out before the end of the calendar year, if possible. When it starts, it's around 4% of the overall account value. So if you have, $100,000 in an IRA, roughly your RMD is going to be about $4,000, and that percentage increases every single year that you age. But of course, maybe that account balance might possibly go down.
Okay, so this applies to everyone across the board who's 73.
Yeah,
or
everyone
older.
who's 73 and has pre-tax retirement assets, which are most people. Most of the time, the money in your 401k and your IRA is pre-tax.
Okay, so what if they have unpre-taxed?
Yeah, like Roth accounts, for example, or just like an investment after-tax brokerage account. Those are not impacted by required minimum distributions.
So you can just hang on to those savings.
Yeah, you can just allow it to continue to grow. That's one of the reasons why, last time when we talked about Roth conversions, they can be really helpful because after you do the conversion and put it in the Roth account, the taxes have been paid on it, and so the government's not going to force you to pull money out of it, at least under current legislation. There's no RMDs on Roth money, and so it can just continue to grow. Because there's a lot of people that, their RMD might be $10,000, $15,000, $20,000 every year, and they're saying, I don't need to take this withdrawal. I'd rather just leave it in the account here, but the government forces you to take it out because it adds to your taxable income and increases the taxes that you pay them at the end of the year.
I'm now seeing this pattern. I'm now seeing where all the roads lead us to is the government wants their money.
Right.
They want your money. They're going to force you to move your money so they can take their money.
Right.
Wow. So it's not even helpful. At first, I thought it had something to do with, well, maybe they think that you'll need that money. Maybe they're just trying to kickstart your retirement and give you a little bit of payout. Wow. Okay, so that's interesting. So what should people start thinking about or start preparing as they enter into that 73 to be able to get those distributions? The best time to prepare is before these required minimum distributions even start. So especially if you're retired or close to retired, that's when we start to look at, do we want to do some of these Roth conversions ahead of time so that we don't get hit with these really high RMDs in the future? Because there's people that they retire at 65, they have several years where they're in a low tax bracket and they love it, and then all of a sudden those RMDs start. And if those RMDs are $20,000, $30,000, $40,000, $50,000, it can easily kick you up into a higher tax bracket. And then they're saying, oh man, I wish I would have used kind of the room that I had back from 65 to 73 to my advantage. So the best time to plan is ahead of time. The second best time to plan is right now. So if you're somebody in that situation, we can take a look at what those RMDs are going to be. And there's unique things that we can do right now, even to help avoid it. One of them would be qualified charitable distributions. There's folks that are, tithing $5,000 a year to their church, and they're just doing it from their checking account. If you're over 70 and a half, so we love those half ages. If you're over 70 and a half, 3 days.
Yeah, exactly. You can do qualified charitable distributions from your IRA, and it actually counts toward that required minimum distribution, and it comes out tax-free. So that's a way where we can still do the RMD and the government doesn't take any taxes from you as if it's going to a qualified kind of charitable organization like a church, for example.
Yeah. Okay, so what happens if people don't take it out? Like either they don't know or they're being defiant.
Right, yeah. So the government has pretty stiff penalties. They still make you take it out, and you have to pay a 25% penalty on that amount. So if it was 10 grand that you were supposed to take out, they're going to charge you $2,500, and you still have to end up taking it out. It actually used to be 50, so they lowered it to 25. How generous, of course, right?
Oh my gosh.
Usually there are ways to get out of it. So I mean, there are certain forms and things like that that you can file to say, I forgot about it, I didn't realize it, I corrected it as soon as I found out, but it's a very stiff penalty, so we like to avoid that.
That is highway robbery.
It is, yeah.
Like, what?
Right.
The 50%, I'm just like deceased. Like, I can't. Like, what?
Yeah.
Okay, so this is even more proof that a financial planner is so important, because these little tricks that's happening with our taxes, with the government, with revenue services, you have to be on your P's and Q's, dot every I, cross every T, because they will take your money.
Yeah, and they change the rules every year, right?
Yes.
Of course, so all the time they're changing the rules, so we like to stay on top of that for our clients. We do a big analysis at the end of the year. We look through every single one of our clients' accounts and say, for those people who are over 73, have they taken the required minimum distribution across everything? Maybe you have multiple accounts too. You might have an IRA annuity. You might have an IRA at Charles Schwab. You can actually satisfy both RMDs just from one account if you wanted to. But we need to make sure that clients are doing that. So we do a big analysis across all of our clients, make sure that it's taken care of. Technically, it is the individual account holder's responsibility to make sure it's taken care of. But that's the thing like that we like to do due diligence on for all of our clients, so they don't get hit with that 25% penalty.
Yeah, okay, so in these months, this October, November, December, this is just a really strong time to come and get these end of year stuff handled.
Yeah.
Required minimum distributions and Roth conversions.
Yeah, absolutely.
All right, well, thank you, Caleb.
Thank
You're
you.
going to be busy.
Yeah, we are.
And if you would like more information about Foster Financial, now is the time to contact them. You have so much to do. Gather your finances, start planning and seeing where you fall. Retirement could be close. You could just now be starting to do financial planning, and you need assistance. So Foster Financial is here to help. Their phone number is listed below, and I'll see you after the break. This segment sponsored by Foster Financial.